everyone, one technology ETF has multiplied investor money by more than 8 times over the past decade, while charging nearly nothing in fees. But combining 4 specific funds creates something more powerful, a portfolio that captures every market condition, generates growing income, and costs less than coffee monthly. The third fund I reveal holds only companies that have raised dividends for at least 10 consecutive years and yields around 1.6%. Here's what Wall Street won't tell you. Institutional money floods into underperforming assets right before they outperform. Smart money doesn't chase yesterday's winners, they accumulate during weakness. I watched my father lose years of retirement savings because his advisor charged him over $200,000 in fees without beating a simple index fund. That taught me the power of low-cost investing done right. I'm showing you the exact 4-fund strategy. You'll learn which fund has historically delivered the highest returns, why dividend stocks outperform during specific cycles, and age-based formulas that maximize gains while cutting risk. The $200,000 mistake most investors make. Financial advisors typically charge 1% annually and rarely beat simple index funds. On a $500,000 portfolio, that's $5,000 extracted every year. Compound that over 3 decades and you've surrendered over $200,000 plus all the growth that money would have generated. The average investor owns more than 20 different holdings and still underperforms. More complexity doesn't create better results. You need exactly 4 funds. Fund 1, VOO, the self-cleansing machine. VOO tracks over 500 of America's largest companies through one ruthless system. Failing businesses get removed, dominant ones get added automatically. What this delivers: historical annualized returns around 15%, rock bottom fees of 0.03%, dividend yield around 1.1%, and consistent wealth building. A typical investment in VOO over a full market cycle has more than quadrupled. 0 stock picking required. The index handles everything. When Blockbuster collapsed, VOO eliminated it. When Tesla dominated, VOO added it. The system never sleeps or gets emotional. But here's the flaw. If retirement is approaching pure stock exposure, when crashes hit, VOO can drop 20 to 40%. Within 5 years of needing money, that volatility destroys timelines. You need acceleration and armor. Fund 2, VGT, the technology multiplier. VGT concentrates entirely on technology, artificial intelligence, cloud computing, semiconductors, enterprise software. What this delivers: historical annualized returns exceeding 22%, fees of 0.10%, highest growth potential of the 4, and exposure to innovation leaders. Over full market cycles, VGT has multiplied investments by 8 times or more. While broad funds quadruple money, VGT historically doubles that performance. The fund holds over 300 technology companies with larger positions in Apple, Microsoft, and Nvidia. Concentration creates explosive growth. Now the critical warning. Technology crashes hardest during panics. In severe downturns, VGT can drop 30% or more, while broader markets fall 15 to 20%. Losing a third right before needing it is catastrophic. VGT is for wealth you're building 7 to 10 years out minimum. This accelerates growth but doesn't preserve capital. Fund 3, VIG, the quality filter. VIG only purchases companies with at least 10 consecutive years of dividend increases. This automatically filters out weak businesses. What this delivers: historical annualized returns in the low to mid-teens, fees of 0.06%, dividend yield around 1.6%, and smoother rides during turbulence. Companies raising dividends for a decade prove fortress-level strength. They generate real cash flow and actual profits. VIG holds growth companies like Broadcom and Microsoft alongside stable dividend payers. These reward shareholders with both rising dividends and stock appreciation. During severe crashes, VIG typically falls significantly less than tech funds. When tech drops 25 to 30%, VIG has historically fallen only 5 to 10%. Downside protection that still builds wealth. Fund 4, SCHD, the Income Fortress. SCHD focuses on high-quality dividend stocks passing rigorous screening. Strong cash flow, high return on equity, reliable payments, and consistent growth. What this delivers? Dividend yields around 3.7%, historical annualized returns around 12%, fees of 0.06%, and income that grows annually. The fund tracks 100 carefully selected American companies. Holdings include Bristol, Myers, Squibb, yielding over 4%, Lockheed Martin with decades of dividend increases, ConocoPhillips generating massive energy cash flow, and Chevron providing inflation protection. Here's what institutions understand. When quality dividend funds underperform growth temporarily, that creates ideal accumulation opportunity. Professionals position ahead of rotations. They buy dividend strength when others chase momentum. The market rotation cycle. Markets rotate predictably. Technology dominates for years, then value leads. Growth runs, then income takes over. When interest rates decline, dividend stocks typically outperform. When inflation spikes, companies with pricing power protect portfolios. When tech momentum slows, defensive sectors continue delivering. SCHD's sector positioning: energy at 20%, consumer staples at 18%, healthcare around 16%, industrials at 12%, with technology under 9%. Compare that to the S&P 500's 37% technology concentration. When tech pauses, SCHD's defensive positioning performs. SCHD generates roughly 3.3 times more dividend income than VOO on identical investments, growing reliable quarterly cash flow regardless of price movements. Age-based allocation blueprint. Ages 35 to 45, maximum growth, 40% VOO, 30% VGT, 30% SCHD. Aggressive tech exposure with decades to recover while building income. Target historical range, 14 to 17% annually. Ages 45 to 55, balanced. 35% VOO, 20% VGT, 20% VIG, 25% SCHD. Reduced tech risk while income and stability reach 45%. Target historical range 12 to 15% annually. Ages 55 plus, income priority. 30% VOO, 10% VGT, 25% VIG, 35% SCHD. SCHD becomes dominant for cash flow. Tech risk minimized. Target historical range 10 to 13% annually. Why this destroys managed portfolios. 4 funds and a 6-figure portfolio costs roughly $40 to $60 annually. Advisors charging 1% extract over $1,000 yearly from identical assets. Across 3 decades, that difference approaches $200,000 stolen plus all compound growth surrendered. These 4 funds generate 2 to 3% in annual dividends based on allocation, thousands in annual cash flow while principal compounds. The tax advantage. ETFs only trigger capital gains when you sell. Mutual funds force tax payments on internal gains even when holding. In taxable accounts, this creates substantial annual savings. Over decades, the tax efficiency compounds into tens of thousands in additional wealth, while actively managed funds distribute capital gains annually. These ETFs let you control when you pay taxes. That's money staying invested and compounding instead of going to the IRS. Wall Street despises tax-efficient structures because complexity justifies fees. Implementation system. Step 1. Open commission-free accounts at Vanguard, Schwab, or Fidelity. Step 2. Calculate your age-based allocation from models above. Step 3. Purchase all 4 funds same day, never time market entry. Step 4. Automate monthly contributions. Even modest amounts become substantial through consistent investing. Step 5. Rebalance annually. When any fund exceeds target by 10%, sell portions and buy underweights. This forces selling high, buying low automatically. The rotation advantage. Markets rotate between growth and value, technology and dividends, momentum and quality. No approach dominates permanently. This four-fund strategy wins across environments. VOO captures economic growth regardless of leading sectors. VGT delivers explosive returns during technology dominances. VIG provides stability and growing income through cycles. SCHD generates high income and outperforms when dividends rotate into favor. You're positioned for multiple scenarios simultaneously, not gambling on one outcome. The bottom line: 4 funds, age-appropriate allocation, monthly automation, annual rebalancing. Compound growth executes while you live. Total annual cost on 6 figures, under $100. Total time required, 1 hour yearly. Total potential, generational wealth built systematically. If you want fidelity comparisons or advanced rebalancing tactics, subscribe. I break down complex investing so you build wealth without Wall Street confusion. For educational purposes only, this is not financial advice. Consult a qualified financial advisor before making investment decisions. Past performance doesn't guarantee future results. This is InvestED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies Wall Street won't tell you. Investing smart, profitable investing.